let's talk about how you could be your own bank. For one, the reason why we go to banks is because they are FDIC insured. We've been doing that our whole lives. It's safe. But it is only FDIC insured up to how much? $250,000, which may not seem like the biggest number until you're in a situation where maybe you just closed a massive deal and you find out that those banks have given out all this money to people that are not able to pay back those loans. And if there's an economic crash, that's why they had to have a bailout, because all these people are going to lose all of their life savings that they happen to have in banks above $250,000. Just like there's insurance companies that insure cars and homes and boats and buildings, there's also insurance companies that specialize in insuring money. Okay, so if you're going to insure anything, whether it's your house, right, or whether it's your money, you should probably go with what's called an A+ rated. So there's all these different rating services, S&P, there's Moody's, AM Best, and they rate insurance entities based on their financial strength, stability, how long they've been in business, and their positive or negative outlooks. Okay, so we always use A+ rated companies to insure our clients' money. They also have different reserves. So banks have how much in reserves, percentage-wise? 10%. Insurance companies do not loan money out. Insurance companies hold on to all their reserves. They have minimum reserve requirements. They must have $1.06 for every $1 that they insure. So if, for example, you buy home insurance from Farmers Insurance, okay, and your house is worth $200,000, they have to have $212,000 in their reserves to justify accepting your premiums for the risk of covering your house. Because if your house burns down, they got to write a check, right, to replace that house. So that's how insurance works. They have to have that money in reserves. So the companies that are most effective at insuring money for our clients, these are companies that have been in business. Not only are they A+ rated, they've also been in business for over 100+ years. There's a huge company that's here in Texas, been around for 175 years. They have $65 billion in assets, and they have a reserve of $4.50 for every $1 that myself and my clients have with them. Okay, they hold on to money for very large companies, individuals, very wealthy individuals, private family. A mutual company means that they are not a stock company. A stock company, collectively owned by stockholders, so they are loyal to their stockholders first and the client second. There are companies that are called mutual companies. Mutual just means that they are collectively owned by their clients. Their board is made up of clients. So we use mutual companies because obviously that puts us in control. We are partners with that company. We are not customers of that company like we are with a bank. Now, this is where maybe some of the similarities where we think about banking. First thing most people think of with banks is at least it's safe. But this is where we're going to get away from that analogy. We're talking about the difference of not tens of thousands, hundreds of thousands, if not millions of dollars that you should have later in life, and most people don't. Because over 70% of Americans have all their money sitting in regular bank accounts, earning basically nothing, right? Getting outpaced by inflation, and their money is being devalued because of all this currency being printed and all that sort of stuff, right? So do you think not losing money and still being able to make 8% completely passive for the rest of your life sounds okay? Now, what about taxes? When I was getting into the financial industry, and I started researching some of the most successful investors in the history of our country, I was looking for these amazing tips when it comes to investments. You know what? A lot of us really have access to a lot of the same things. And it's not that the most successful investors out there are so much better at, growing their money. They're really good at protecting their money, right? And one of the biggest adversaries for very successful investors is learning how to protect their money from taxes. So what if I told you that you could put your money in a bank where your own bank, all your money would be safe for the rest of your life and fully insured with all those reserves? It would be with a company that's been around for a long time. You could get market-like returns, and you would never have to pay taxes on the gains and the access, and ultimately upon your passing, all of that money would go to your trust, heirs, beneficiary, or whatever, 100% tax-free. So we're getting a little bit better. What about liquidity and control? Some of you might have heard of IRAs and 401ks, right? That would be all of us. We've all heard of IRAs and 401ks. That's the most common strategy that Americans will use to accumulate money to become financially independent someday. Does anyone know who created the IRA and 401k? The government came up with the strategy of the IRA 401k to give the American worker a chance to be able to put money away, right? And they can't really, put in too much, but they can put in so much so that they don't have to pay taxes on that money that goes in, which is a great deal, right? And you've probably heard people your whole life say, yeah, that's why you should put all the money you can that you're allowed to into a 401k, an IRA, SEP. Okay, now think about it. Do you have to pay taxes on those gains inside that IRA or 401k? How old do you have to be before they allow you to start pulling money out of your 401k? 59 and a half. Why? Has anyone who's turned 59 and a half, can you tell us exactly what happens at that point that makes you more financially responsible? I'm not sure why the government decided at 59 and a half you are now free to spend your money. But here's what I do know. They know that people are going to have a career for like another, 30, 40 years, and they understand that compound interest deal. Because when you put your money in your IRA, your 401k, you're going to put it in some sort of an investment, and the amount of money that you put in should be far less than what it grows up to be, okay? And if you think of it from their perspective, would you rather tax this or that? Okay, so the government's really not all that patient, but they're smart enough to know that if we make you wait till you're 59 and a half and we make you put that money in this investment, and maybe we raise taxes in the next 30 or 40 years, could they get a bigger piece of the pie for themselves? Sure could. Now, it doesn't mean that IRAs and 401ks are bad, and that's not my point here. It doesn't mean that banks are bad. You just have to understand these things. There's not one thing that does everything, but what I'm going to talk to you about today, infinite banking, allows you to be able to have tax-free growth, tax-free access for the rest of your life, as well as liquidity. Because this is a private market product, okay, not a public qualified plan, you have the ability to put money in and take money out at any time for any reason. So you don't have to have an exception, and you don't have to pay penalty, and you don't have to pay tax and lose upwards of half of your money. And you get to control it, right? Some of you have heard of a Roth. So far when we were talking about taxes, that sounds sort of similar to a Roth. Problem is, if you make too much money, you can't even do a Roth. And there's for whatever reason, you can put a lot more money in 401ks, you can put a lot less money in Roths. Anyone notice that? Well, this strategy a lot of times has been referred to as the rich man's Roth because it's customized based on your own income or asset level. We've had people start out these accounts saving $500, $600 a month. We've also had people that do $500,000 or $600,000 a year into these exact same strategies, because it's all based on you, right? You do have to go through suitability. You have to be able to show that you have legitimate income and or assets in which to fund it, but so long as you do, you can put in as much money as you want into this strategy. Leveraging. Now this is where the savvy investors fall in love, okay? That last slide we were looking at, is money cheap for us right now to borrow? What if within your own bank account that gives you all of these things, because you are a partner of a mutual company, they will give you this loan at an average interest rate of somewhere between 4 to 5% that you have the option to pay back if and when you decide. You can make interest payments if you want to, but you don't have to. So if you compare that versus like a home equity line of credit, right? So my bank, I have a home equity line of credit. I can go to them and I can borrow against the equity in my house, and I have to start making interest payments on it. And those interest rates right now are like 8, 9%, I believe. So I'm paying 8 to 9%, and I must make interest payments on it whether I want to or not. In this situation, the interest rate is half, maybe a third other options, and you can choose to pay it back or not. Meanwhile, your money is still earning an average of about 8%. So here's how this works. Your account, you're adding money, and you're making about 8-ish%. Great. Continues to grow for the rest of your life, compounds forever. The money is never leaving. You are borrowing against it. So you're taking a loan against that. The loan is coming from that insurance company to you at around 4 to 5%. It's capped. It can never be higher than 6. I've never seen it higher than 5.5% in 15 years. Okay, but the point is, if you decide to pay off that loan, it's going to cost you 4%. Meanwhile, your account is still earning 8%, and guess what kind of percent you could make on that money in some sort of a commercial real estate investment? What percent would you plan to make? Whatever option you have, whether you are really conservative and you just want to invest in something that's going to make 8, 10%, right? You could buy notes and make 8%. Let's make it 16, and let's make it tax-free. You like apples? Legal protection. Here in the state of Texas, as well as most states, creditors can come after you for a lot of things, but they cannot touch money inside of insurance companies.
How to choose the contractor? I would say go on your power team, network with the right people, and see how many deals have that contract have helped your network. Review is a must, and not just review online, but the people that have worked with those contractors and how long have they worked with them. Because if you don't choose the right contract, you can lose money like that. Say never pay your contract up front. Click on the link in the comments below and subscribe to our YouTube channel as well, and we'll keep give you more information as well. So stay tuned.